So good morning, everybody. I'm very happy to welcome you for AXA's presentation of a half-year 2012 earnings. Today we'll be presenting Henri de Castries, Chairman and CEO of AXA, Denis Duvergne, Deputy CEO, and Gérald Darlin, Group CFO. The presentation will then be followed by a Q&A. You'll have the possibility to ask questions in the room, and then we'll take questions over the phone and through internet. Henri, I can now hand over to you.
Thank you, Mathieu. So we are here to share with you the half-year results, which we see as being solid in a difficult environment. If you look at these results, I just would like to have the right chart, and I don't have it. I'd like to have the previous one. No, the previous one. Okay. The underlying earnings, as you will see, are stable at 2.3 billion. Adjusted earnings are stable. The net income, if you take out the exceptionals of last year, is stable too. Solvency ratios are comfortable, and I'll come back to that. And you will see that from an operating standpoint, things are moving in the right direction in all the three business lines: property casualty, health and protection, and savings and asset management. What's the environment? I'm not going to elaborate for long on the Eurozone crisis, but it's clearly creating clouds over the industry. The financial markets have been difficult, and if you compare them to the first half of last year, it's clear that equity markets have decreased. Interest rates are much lower in the strongest economies. Spreads are much wider in the weaker economies. The economic outlook is not very favorable for the GDP evolution in the Eurozone, and we remain with a significant amount of regulatory uncertainties surrounding the financial services, one of them being, of course, for insurers, the evolution of Solvency II, even if some steps in the good direction have been made there. So, where do we stand as AXA for this half year? As I said, underlying earnings are on a comparable basis stable. On a published basis, they are up a little less than 100 million. Adjusted earnings are stable too. And the net income, if you take out the proceeds of the disposal of Taikang and of our Australian activities last year, are stable too. Stability in a difficult environment. The majority of the earnings is coming from the segments which are less sensitive to financial markets, where we are seeing a significant and positive evolution. Property and casualty is up and represents 44% of the underlying earnings. You will see the progress made on the combined ratio. Protection and health is up 9%, which we see as being a good performance and represents a little less than a third of the business. So if you take these two segments, you have 3/4 of the business. On 3/4 of the business, underlying earnings are up, and revenues also progress in a very decent way. The portion of the business which is affected by the financial markets is savings and asset management, where underlying earnings are down 14%. This is a reflection of what the environment has been. If you look at our solvency margins, our solvency levels, and I think this is something important in these volatile times, Solvency I, which I'm not going to insist very much on, is reaching historical highs at above 200%, 207%. It's more important to focus for a few seconds on Solvency II, and we are presenting here for the first time the solvency ratio with the benefit of the equivalence. Why do we do that? Well, because it's one of the points where the Solvency II negotiation has progressed well because Mr. Barnier has expressed himself loud and clear more than once, saying that yes, equivalence was something which would happen, and that the equivalence with the US is something which the industry could take into account. It's important because this is one of the key requests of the industry, and it's the one where we have clarity. We do not have at this stage clarity on counter-cyclical premiums, matching premiums, but on equivalence we have clarity. So we think we can take it into account in the computation of our Solvency II ratio. And what this shows is that the ratio has declined since the end of last year due to the decline, principally the decline in the markets, the payment of the dividend, partly offset by the returns during the first half. But this leaves us in a situation which we see as comfortable because we are at 174, including the benefit of the equivalence. Denis will come back to that. It's 136 without this benefit, but we think that the right regulatory way to look at the capital situation is to take into account the equivalence, and you see that we are there at very comfortable levels. The gearing ratio is very slightly up. This is not due to the fact that our debt would have increased. It has in fact slightly decreased. It's just because, as you know, we have made some accounting changes on the DAC policies at the end of last year, and the accounting retreatment is leading to a mechanical increase by 1 point, not very far away from the long-term goal of 25%. What do I want to say on the alignment of these earnings, of this set of results with the long-term goals of Ambition AXA? I think despite an environment which is not favorable, because the performance is impacted by market conditions, we are well aligned with our long-term goals, and we are continuing to implement the operational initiatives and to deliver on them. Selectivity in the major markets, acceleration in the emerging ones and in the business lines where we see we can capture growth and margins, and efficiency where the savings efforts, which should represent at the end of 2015 1.5 billion, are very well on track. Underlying earnings are at 0.92 euros for the semester. They were at 0.90 euros last year for the first half. The progression over 2 years is 4%. It's below the long-term target of Ambition AXA, but as you will remember, when we set out the goals for Ambition AXA, we were assuming market assumptions, which were a positive evolution of the equity markets and gradually increasing interest rates. It's not what we have seen. If you take into account the sensitivities, we are in line with what the sensitivities were. Return on equity. The return on equity is slightly progressing when compared with last year at 13.8%, progressing on the way to the 15% we think we can reach at the end of 2015. The operating cash flows are in line with the plan, and the gearing, I've already mentioned it, is also, if you take the 2 years perspective, evolving towards what the long-term goals are. If you start to look into slightly more detail at the operations, I think on the life and savings side, the important point for you is to understand if our efforts of selectivity are bearing fruit. We have said at the very beginning that we wanted to increase the exposure to health and protection because these are businesses where the demand is there, where margins are satisfactory, and that we wanted to put less emphasis on the general account and savings business. If you look at the transformation over the last 2 years, you will see that this semester reflects the fact that this is well on track. the proportion of the protection business has moved from 31 to 41%. The compounded APE growth since the beginning of the plan in health and protection is 16%, whereas on the general account, where we want to put less emphasis, it's the reverse. The share of general account in the mixed has declined from 26 to 17%, declining by approximately 17% on a compounded base. Unit-linked remains more or less stable at around 30%, which we think is a decent performance given what the state of the markets is. We think these are good products for the clients, delivering reasonable margins for us. We want to keep them at a high level in the mix, and I think we are achieving it. So as you see, the transformation efforts on the life business are bearing fruit. The new business value margins, they've been progressing. For the first half, they are pretty stable, slightly increasing if you compare it to last year. And we think we can continue to improve them further between now and 2015. If you look at the second significant business, property casualty is well aligned, well on track, satisfactory on nearly all fronts, because we combine what we see as being a good revenue growth, approximately 4%, with a very good improvement in the profitability. The combined ratio for the current year is improving versus last year. The combined ratio all years is improving versus last year and stands now at 96.4%, not very far away from the 2015 goal. So we are pleased with what we see on the P&C side. Last but not least, asset management, which has been an area of concern during the financial turmoil for different reasons at AXA IM and AXA Rosenberg. Things are gradually improving. Investment performance first, which is important for the clients, important for the insurance portfolios, is good. The flows are still negative, but are starting to improve. The net flows were negative 23 billion for the first half of last year. It's only 8 billion for the first half of this year. And so we think that we are gradually seeing a return to a more normalized situation. AB in particular is positive again on the retail side. And you can see that at AXA IM in some of their core specialties, they are positive. So we are seeing there a gradual improvement in a picture where underlying earnings are pretty stable and resilient. Cost savings plan, I've mentioned it. We have achieved in the first half exactly what we intended to achieve. So we have now saved 500 million out of the 0.5 billion we intended to save between 2010 and 2015, which means we still have 1 billion to save. So we will achieve that. We have the goal of maintaining in property, casualty, and life and savings the admin costs well under control. We have detailed plans, and we want to reduce the acquisition expenses in the property casualty business by 1.5 points. We are comfortable that we can reach that because the plans are now well identified. So this was just a brief introduction. If there is one thing to have in mind, we think this is a solid set of results with a solid balance sheet in an environment which remains volatile and troubled, but is not going to distract us from the long-term orientations. I'm now going to leave the floor to Denis, who is going to go into more details on the various business segments.
Thank you, Henri. Good morning, ladies and gentlemen. A big thank you to those of you who have crossed the channel in the middle of the Olympics to attend this presentation in Paris today. I will go straight into the group earnings. And I will skip slide 17 to go directly to slide 18, where you have a waterfall showing the evolution of the earnings between the first half of 11 and the first half of 2012. You see that we had slightly better life and savings earnings. The decrease in the US being more than compensated by an improvement in Japan. We didn't have a repeat of the, thank God, a repeat of the tsunami and earthquake in Japan. P&C was up also thanks to an improved combined ratio. We had a negative on international insurance just because we had less positive developments on our runoff portfolios. Asset management was pretty flat. Holdings were negative because we've converted some of our debt from Swiss franc and yen into euros, which increased the interest charge. And we had a positive impact of 73 million of the foreign exchange because of an appreciation of most currencies against the euro. Moving to adjusted earnings and net income. Adjusted earnings were pretty flat in the first half. They were mainly impacted by lower realized capital gains on equities and real estate, and partly offset by lower impairments, mainly due to the non-repeat of the first tranche of our Greek impairment on government bonds in the first half of last year. Net income, as Henri mentioned earlier, was stable if you exclude the exceptional gains that we made last year on the disposal of our 15% stake in Taikang Life in China and the disposal of our Australia and New Zealand operations as part of our buyout of our Asian minorities. Moving to efficiency, I don't have new figures to add there, but just to comment, you will recall that our efficiency program is relying on maintaining our P&C and life and savings admin costs, offsetting the impact of inflation, and reducing our P&C acquisition expense ratio by 1.5 points. Of the 160 million that we saved in the first half, roughly 100 million came from administrative expenses savings, and 60 million came from reduction of P&C acquisition costs. Moving to the life and savings, new business sales and margins by markets. You see that in mature markets, we had a growth of APE of 1%, with a stable margin at 21%. And we saw a slight decline of our new business sales in high growth markets, which is not what we would like in the long term. There is, I believe, a one-off effect which relates to Central and Eastern Europe, where we had a decline of 36%. This decline was a function of the fact that most of our presence in Central and Eastern Europe was focused on the pension market. There was a change of regulation in Poland, which followed the year before the nationalization of pensions in Hungary. In Poland, the compulsory contributions have been sharply reduced and are now very, very small. We have to convert our sales force to selling more life business, and it's not a transformation that happens in one go. We are, however, optimistic about the development in that region, but we should see that in the following quarters. In Asia, we saw our sales growing by 9%. This is the combination of flat sales in Hong Kong and a growth of 18% in the rest of the region, Southeast Asia, India, and China. The margins were pretty good at 42% in high growth markets. Overall, flat AP on a constant Forex basis and slightly higher new business margin. I will comment on that later, 24.2 to 24.4 in a declining interest rate environment. When you look at the mix of business, we are, as Henri mentioned, fully in line with our commitment to be more selective. We are growing protection and health this year at the pace of 5%, with strong sales in Asia, Germany, and Japan. In Germany, because of the expected change in regulation on the health side, and also in Japan because of new products that we've developed both on protection and health, and as well in France with the strong development of a long-term care program. The government is not yet making any change to regulation there, so all the communication around long-term care is leading people to take care of their long-term care protection by themselves. General account savings sales were down 6%. New business margin remains negative. Low profitability in France and Italy, and lower volumes in France and Italy. Slightly bigger volumes in Belgium, but all in all, this is clearly not the area that we're emphasizing. We are trying to mix those savings with unit-linked on the new business side. Unit-linked, our performance was good on margins at 22%. Strong sales performance in the US and Italy, more than offset by CEE, which I've already mentioned, and the UK, where the evolution of regulation on bank assurance is leading to a strong decline of the sales in that channel. Finally, mutual funds, good performance with a strong performance in the UK, thanks to our Elevate platform, partly offset by lower sales in the US. When you look at the evolution of our new business margin, you see that we have managed to more than fully offset the impact of declining interest rates, which affects our GMXB margin, by an improved business mix with a higher protection and health, higher contribution from high growth markets, and lower expenses. So we are well on our way and in line with our commitment to invest more money into protection and health and unit-linked and less capital on general account savings. Moving to the evolution of earnings on the life and savings side, you see that we had a negative evolution of our earnings on the US GMXBs, US variable annuities, a slightly negative investment margin, evolution of the investment margin from 76 to 72 basis points. And this was more than offset by better fees and revenues. In fact, slightly lower unit-linked fees, more than offset by higher margin on revenues, pretty stable technical margin, better expenses, a positive impact of Forex, and a positive impact of taxes. I mentioned already the fact that we had a negative evolution in the US GMXB earnings. I will focus on the last column, where you see that we had hedge margin negative 90 million. We expect a slightly negative hedge margin. You see that basis risk increased a little bit compared to last year, but was pretty contained. Volatility was a bit higher, but we had hedge volatility in the first half. Slightly negative impact of interest rates. You see that on the lapse experience side, where we had a significant reserve in the second half of 2011, our experience is stable, which is good. So we told you we would bring our reserves in line with our current experience. This current experience remains the same, so no need to strengthen the reserves on lapse experience. But we had to strengthen our reserves on partial withdrawals. It's a negative of 137 million euros. What we are doing here is we are taking into account the fact that because of lower interest rates, our customers have reduced their partial withdrawals to take a hit, which reflects a view that this experience will continue the same in the future, and therefore we're taking the full hit of that change in experience on partial withdrawals. This is partly offset by positive reserve adjustments, which relate mainly to the impact of premium suspension and some model refinements. What is premium suspension? We have announced at the end of last year and implemented in March in March, the elimination of the possibility for our customers to put in more money into old contracts with high levels of guarantees. So this is leading to a better level of, an improvement in the economic situation, which leads to lower reserves. Moving to the detailed performance on the different subsegments within life, we saw protection and health pre-tax earnings grow by 9%. This is largely a reflection of the improvement of the situation in Japan, where we had a non-repeat of the earthquake of last year. General account savings performance was plus 3%. We have lower expenses. It's partly offset by lower investment margin, but the net is positive. Unit-linked excluding variable annuities, plus 28%. It's a combination of higher upfront charges in AXA MPS, where we saw big sales of unit-linked in the first half, and boni on protection riders in France, and also lower expenses. Finally, US variable annuities, where we move from a profit to a small loss of 10 million euros. I will now cover property casualty, where we are quite pleased to see a growth in revenues of 3.7%, which affects both personal lines, plus 3%, with an average price increase of 3%, and an increase in volumes, more than 600,000 new exposures, offset by lower average premiums. Commercial lines is a nice development as well, with a revenue growth of 5%, which is a combination, an average price increase of 2.7%, and a more favorable business mix. We have positive impact of higher exposures there on a per contract basis, which is a positive development. When you look at the pricing picture around our footprint, you see that we continue to have a positive price evolution in all territories, with the exception of Switzerland, where I remind you that our combined ratio is at 89%. This evolution, positive evolution of prices, can be seen both on personal lines and commercial lines. Of note, the strong increase of prices in Belgium on personal lines and in the UK on personal lines, as well as in commercial lines in the UK and France. Moving to the evolution of the revenues and margins by market. Mature markets saw a growth of the revenues of 2.4% and a positive evolution of the current year combined ratio of 0.8 points. High growth markets, quite strong growth, accelerating at 17.4%. This is true both in Asia, in the Middle East, and in Mexico, with a slight decrease of the current year combined ratio. Direct, it's a combination of two stories. Sharp decline of the UK direct, down 29% on the revenue side. The very fast growth that we had experienced in the previous years, being tamed by strong price increases that we implemented at the beginning of this year. And strong growth of 10% in the rest of our direct footprint, both in Europe and in Asia. And a small decrease of the current year combined ratio at 103%. All in all, 3.7%, and a good decline of the current year combined ratio. Looking at it in more details, you see that this is a 4% earnings increase. You see also that we had slightly less favorable weather experience, which manifests itself in the cost of natural catastrophes of 0.5 points against 0.1. This does not include also a deterioration of the freeze impact, which was worse by 0.9 points compared to last year, which in total means that we have a deterioration of 1.3 points coming from weather, and a total cost of weather of 1.7 points, which is quite substantial. Prior reserve developments were slightly more favorable this year than last year, 2.1% against 2%, leading in total to an all-year combined ratio of 96.4%, very close to our medium-term target of 96%. Investment income was stable, with an asset yield that was stable at 4% in P&C. In asset management, our average AUM were stable at AXA Investment Managers, with a negative impact of investment solutions, essentially employee shareholding plans, which were not profitable and where we had an outflow of 4 billion euros. This was partly offset by fixed income +1 and equity +1. And on the equity side, it's a combination of quite positive flows at AXA Framlington and AXA Private Equity, offset by still a negative flow at AXA Rosenberg. AllianceBernstein average AUM declined by 9%. Again, a mix of a continuation of significant outflows of 17 billion in equities, almost offset by positive 8 billion on fixed income and 3 billion in alternatives. The net outflows at AllianceBernstein at -5 are much, much better than what they were last year, and we seem to see a brighter horizon on the AllianceBernstein front. All in all, for asset management, earnings were slightly up, -4% after taking into account the Forex impact. Revenues were down 10%, but expenses managed to match the revenue decline at -11%, allowing a good, reasonable experience on the earnings side. I will now hand over the floor to Gérald Darlin, who will talk to you about the balance sheet. Thank you very much for your attention.
Good morning. Let's start first with shareholders' equity. And we have, as mentioned before by Henri, we have a restatement of -2.1 billion, corresponding that it's absolutely in line with what we told you in February. And this corresponds to a change in deferred acquisition cost accounting methodology, which is in line with US GAAP and which has been enforced on January 1st, 2012. So we have restated retrospectively, and that corresponds to a -2.1 negative adjustment. Starting from 2011 shareholders' equity after restatements, we are at 46.5, and we have an increase of 2.2 billion. You can see on the right-hand side the main elements, the main driver of this evolution, starting first with the net income for the period, plus 2.6 billion. The increase in net unrealized capital gains coming mostly from the decrease of spreads and decrease of interest rates, plus 1.7. Then we have the FX movement net of hedging instruments, because we have a lower euro and we are benefiting from this situation from our international presence, plus 0.6. Then we have dividend, minus 1.6, and the change in pension benefit, which is negative. Why? Because all our liabilities are discounted with a AA bond yield. So let's move to Solvency I. On Solvency I, we have an increase. We are at 207%, which is a record level, mostly due to the very low interest rate environments. And you can see that the sensitivities are mostly geared to the interest rates. So the interest rates explain most of the move going forward. Let's move to the economic solvency. As explained by Henri, it's an economic solvency which is presented here with equivalence for the US business. That means that for the US, the requirement is based on a 300% risk-based capital. And we have a decline from 183 to 174%. Let's move to the economic solvency without equivalence, which is on the top right, where we have a decline from 148 to 136, which is mostly explained by the low interest rates environment. And then it's interesting to go through the sensitivities. And here I would like to mention that first, these sensitivities are made without equivalence. And I have two remarks. First of all, let's have a look at the interest rate minus 100 basis points. We would end up with an economic solvency without equivalence at 119. 119 would correspond to a situation that would be close to the Swiss interest rate environment. That means that interest rate would be close to 50, 60 basis points. So we can consider this as a floor. And with equivalence, we would be at a level that we consider would be very comfortable, and equivalence would bring us a comfortable margin. The second remark relates to the corporate spreads. You can see that the last sensitivity, corporate spread plus 75 basis points, this is made with a liquidity premium. That explains why you don't have any sensitivities. That means that the negative impact on the asset side from the corporate spread widening by 75 basis points would be offset by the liquidity premium. Let's move now to the debt gearing. Debt gearing is at 27%. Again, it would have been 26 without the DAC methodology restatement, because again, there is a decrease in the denominator since we decreased the denominator by 2.1 billion. In terms of interest rate coverage, we are better off. We increase our interest coverage from 9.1 to 9.7. Let's move to the invested assets. And as you can see, the asset allocation is roughly unchanged. That means that nevertheless, you can notice that we increase the corporate bonds, and that's the main element. We increase from 148 to 155. And as you will see later on, most of our investment have been during the first half in corporate bonds. Let's move to the unrealized gains. You can see that the balance sheet net unrealized capital gains went up from 5.2 billion to 7 billion. The most important drivers are first, the unrealized gains in light blue in government bonds, where we went up from 3.1 to 4.2. And you have, like we did at the end of December, you have the breakdown by sovereign bond. And you can see first that excluding European peripheral countries, we have all countries are positive first, and they are at higher levels than at the end of last year. As far as the Eurozone peripheral countries are concerned, we are at minus 0.6, we were at minus 0.7, and you will see later on that we have slightly decreased the exposure, which explains that we are better off today. On the other categories of assets, you have corporate bonds and equities, and two of them both have improved, specifically the corporate bonds, due to the decline in interest rates and in spread as well. So let's make an update on the peripheral countries. As you can see, and you can notice that the gross book value between the end of 11 and June 30th, 2012, we have a drop of roughly 4 billion. That means that we decreased our gross exposure roughly from 13%, mostly through disposals. You can see also that at 21.3 billion, the gross market value of our peripheral country exposure corresponds to 4.5% of our assets under management. Let's move to ALM, to asset liability management. And start first with life. As expected, the asset yield is slightly down from 3.9 to 3.8. But as you can see on the right-hand side of the graph on the top, we are benefiting from a very long duration of our assets, 7.4 years. And we have been managing, as in the past, the duration gap extremely cautiously, because the gap is less than 1 year today. So 7.4 years, 5 years in P&C, But as far as life is concerned, this explains why we have a small decrease from 3.9 to 3.8. As far as the net investment margin is concerned, we move from 76 to 72 basis points. The guidance that we gave for the earnings release at the end of 2011 was between 70 and 80. We are in line with this guidance. As far as P&C is concerned, the P&C asset yield is flat at 4%. We took the opportunity of these very low interest rates in order to reinforce the protection in case of a rise in interest rates in countries where we have market-sensitive liabilities, like in France, for example, in case of there would be a rise of interest rates. So let's focus now on fixed income investment policy. First, the amount of reinvestment in the first half has been 25 billion, and the reinvestment has been done at 2.9% on average. You can see at the bottom of the right part of the slide that the 2.9 are broken down between the different currencies, and that as far as euro is concerned, we reinvested at 3.2. We didn't invest in the Eurozone peripheral countries. As you can see on the top of the right part, we invested mostly, as I said before, in corporate bonds, 48% of our investment, whereas government bonds is only 22%. It was more in the past, so we have been extremely selective on this investment. Most of the corporate bonds have been invested in non-financial bonds. Let's move another point, two other points, is the yield dilution. We can expect for both life and non-life to have a dilution over 2012 compared to 2011, roughly of 20 basis points. And we confirm that we are still expecting a margin between 70 and 80 basis points for life net investment margin for the full year 2012. Let's move to the investment spread. And this confirms on the left-hand side, you have the in-force business, new business on the right-hand side. First, starting with the in-force, 3.8% compared with 2.2%. That means 160 basis points buffer, which is which gives us flexibility in our crediting rate, and a way to face, in case we would stay in a same environment, interest rate environment, to face any further decrease of crediting rates. We have a significant buffer, as I said, and on the right-hand side, on new business, we have a much lower guaranteed interest rate at 0.7%, corresponding to what we mainly repeated, which is that we stopped in many countries writing new business with guaranteed rates, or we are giving guarantees for a limited period of time. And in continental Europe, as you know, we are selling these spread products in combination with unit-linked. That's the case in France, for example, in order to increase unit-linked shares. Now, the detail between the main countries. First, we could say that for both in-force and new business, we have comfortable buffers. You can see that I would like to make two remarks. First, starting with Switzerland, you might be surprised by the 30 basis point spread on in-force, which seems to be low, but I remind you that most of our profit in group life in Switzerland is derived from the technical margin. Second, as far as Belgium is concerned, we have a spread of 70 basis points only between the assets and the guaranteed liabilities, but this doesn't take into account the fact that we anticipated these new investment at the end of last year, and that we invested in OLOs that at that time had very attractive spreads. So that means that, in fact, the earn rate on the asset is more toward 4% than 3.5%. And now I hand over to Henri.
Thank you, Gérald. I think after this detailed presentation, there is not much to add as a conclusion. I think what you should take out is what I said at the beginning. This is a solid set of earnings, showing that we are progressing towards the goals of Ambition AXA. These goals being well suited to the current environment. We will continue. We are reasonably confident that we will deliver on the long-term objectives, but we also know that the short-term environment may remain pretty volatile and uncertain, but I really think that the resilience of the earnings over the last 3 to 4 years is showing the solidity and the growing solidity of the model we have adopted. Having said that, I suggest we move to the questions. We are going to take questions in the room first. Mics are available. If you just could tell who you are when you raise your question so that the people listening to the call can identify you. Who has the first question? Monsieur Jacquet.
Hi, good morning, Thomas Jacquet, Exane BNP. I have 3 questions. The first one is regarding the taxation of the group. A lot of things are currently taking place in France on that front. I think of the dividend tax and increase in taxation rate. What could be the impact for the group in 2013 and forward? My second question is regarding the economic capital model. Can you remind us what kind of interest rates you take to calculate that between swaps and long-term interest rates anchoring? And my third point is on the UK Life business. When do you expect this business to break even, and are you in line with your plans? Thank you.
Okay, Thomas. What I suggest, Gérald, do you want to answer on the 3 elements? Tax,
yes, on the taxation side.
UK Life for Denis, yeah?
On the taxation side, first, the tax on the financial transaction should be extremely limited, something like 10 million. For the rest, we don't know yet, so we will wait for the announcement in September. Yes, your question about the assumption on the economic capital. Let's be clear on that side. We took really a risk-free rate yield curve. That means that we are using, for the discount of the liabilities, 1.7 for the swap rates. That means on top of this, we have, like in KISS 4, we have a liquidity premium, and this liquidity premium decreased. So we are slightly above 80 basis points, 88 on top of my head. So that means that contrary to what of some others did, we are really calculating this in a risk-free rate environment. In other words, we don't take the average assets and we don't discount at the average or blended rate corresponding to our assets. So that's important because that can explain a lot of the differences that might exist because the solvency that are posted by some of our peers and this solvency.
UK Life.
On the UK Life business, we knew when we sold the bulk of this UK Life business to Resolution in 2010 that the remaining business, which is essentially a wealth management business, was not at scale. And we are building both the Elevate platform and the Archiltas multi-manager platform to scale, and we expect to be profitable in 2014 and making a good return in 2015. So we are fully in line with that plan. The growth of the assets on the Elevate platform and on Archiltas is progressing quite nicely. The only change in the environment that we are not fully predicted is what's happening on the bancassurance market, where essentially the evolution that we see that the FSA is making it extremely difficult to provide advice, because the way they look at it is when the customer has invested in an asset which has made a loss, it means that it was bad advice, which means that the only advice that can be recommended at this stage is cash. So bancassurance is at risk at the moment in the UK, and that explains the much lower volumes that we've seen in the first half. But the progression on our two strategic platforms, Elevate and Architas, is going nicely.
Okay, next question.
William Elderkin from Soc Gen. Two questions. First one on asset yields. Can you explain how the P&C asset yield was stable over the first half at 4%, I think, with new money rates of 2.9, if I understood your slide correctly? And then second, related to that, if interest rates stay where they are over 2013, what roughly would be the impact on the asset yield over that time horizon? And then secondly, on the variable annuity slide, I just wonder if you can talk through how I can reconcile the information given on slide A26, and then secondly on B19, where you break down the technical margin. I couldn't see how they fitted together. And then related to that, can you just give a sense of how conservative your assumptions now are related to the sort of new policyholder utilisation effect you mentioned?
Very good. I suggest that Gerald takes the first part and Denis the second one.
Yes.
Gerald can take both.
Okay, so are you ready?
On the first on the asset yield. First of all, the asset yield is a blended rate, combining different currencies and so on and so forth. So, but as far as the 4% are concerned, this is coming from the fact that, as I explained before, in a country like Belgium, we increased our rates. Why did we increase our rates? Because we have invested in OLOs. And that explains why we succeeded in stabilizing the 4% for P&C, but we have a decrease on the other side. On life. To answer the second part of your...
If the rates were to stay stable in 2013, what would happen? Which was the second part of the first question.
What would happen? It's quite easy. That means that we are investing today on average at 2.9. Take the euro. We are investing at 3.2 points, so that means that starting from a situation where roughly we are at 4, that means that we have to spread the decline of 80 basis points, 80 to 100 basis points over the duration of the assets. That means that taking into account the duration of 7.4 years in life and 5 years in non-life, you can expect to have something like 15 basis points per year, roughly. And that's why we said this year we are on the safe side, saying that we will decrease by 20 basis points. The year after, everything equal, maybe it would be between 15 and 20.
And we believe that that fully justifies our statement that we will be able to maintain our investment margin between 70 and 80 basis points, because we are also managing actively the crediting rate.
VAs?
On USVAs.
So, what could you repeat your question on USVAs? Reconciliation of
the slide on the technical margins with the slide giving the details of the assumptions on policyholders' behavior.
Yeah. Okay. So the way we could explain it. First of all, we have, and that's what is mentioned on page A26. We have a negative contribution from the US of minus 7 million euros. This is compared first with the earnings for the US earnings for the first half at 237. You can see that we have a negative adjustment of 137 and 120. This is on a net basis. That means it's net of tax, net of PB, net of DAC. And on page, which is your question on page 19, you have the figure which are gross. So roughly speaking, you have an adjustment of 542 plus the volatility 143 plus 54, so you have 740 negative gross adjustment, which is mentioned on page 19, B19, And you have to offset the DAC effect, which is roughly 530. It doesn't make the whole, but it gives you a good idea of the offsetting element coming from the DAC.
Next question. Yep.
Yes, good morning. François Boissin from Exane BNP Paribas. Follow-up question on the VA book. It seems that the net impact is much lower than the gross because you actually assume that the DAC impairment will take further to come through. The question is, what is the amount of DAC right now, and what could trigger an accelerated impairment of the stock of DAC in terms of market conditions, in terms of calendar?
John?
Yes. So the amount of DAC in the US went up from this year from 7.2 billion to 7.9 billion. The second part of your question is about what's the level. You know that we have a kind of moving average with a corridor. The name is a corridor. And that means that we are very far from a level where we would have an acceleration of DAC if we would go through this corridor. It's maybe 30% below in terms of equity markets. But at the same time, we are on a regular basis, we are making liability adequacy tests in order to test that we can recover these DAX. So that means that it's not an amount which could grow at a very high level without any expectation for recovery. We are tracking this recovery and we are comfortable that we will recover it.
I would like to add 2 points. First on DAC, the fact that we have lower surrenders and lower partial withdrawals means that the policies stay with us for longer, which justifies that we keep a higher level of DAC because we have a longer period during which we will keep the policies in force. Secondly, to add to the response to the previous question on assumptions, we told you last year that we were bringing our assumptions on surrenders in line with our current experience, and we confirmed in the first half that we had no further reserve to make on surrenders because we remain in line with those assumptions on surrenders. On partial withdrawals, it's the first time that we take a hit because it's the first time that we see a deterioration of the experience. We have taken the full effect of this deterioration of the experience on partial withdrawals. That doesn't mean that the experience could not change in the future, but we have taken the full effect of the current experience on partial withdrawals.
Next question. We are going to take some questions on the phone. I'll ask those who are raising these questions to introduce themselves before raising the question.
We have a question from Mr. Farouk Anis from Morgan Stanley. Sir, please go ahead.
Hi, everybody. I hope you can hear me. Hold on one second. I'll put my phone on mute.
Mr. Anis, you have the floor.
Hi, can you hear me now?
Yes.
Yes.
Okay, sorry about that. So I've got a few questions. Firstly, going back to, I think, William Elderkin's question about the further risk in the VA book, how far away are you from assuming either zero partial withdrawals or zero lapses in the business? So what would, another way of asking this is, what would be the level of reserving you would need if you made that kind of assumption? That's question one. Question two is, you did have a study, I think, internally of going to policyholders and offering them to cancel their liabilities in return for a cash payment. I was wondering how that study is going and what you think the likelihood is of this being a solution. And my third and last question is on economic capital. At what point do you think economic capital becomes a constraint on dividend? So if you did fall to 120, 110%, excluding reduce your dividend below the 40% payout level? Thank you.
Okay, good. Gérald, do you want to take the first part of the question on withdrawals?
As far as partial withdrawal are concerned, we decreased our assumption by 50% for the next years. So that means that we consider that this is quite cautious, and that we won't be in a situation where partial withdrawal will be at zero. It would be a nonsense. So we are taking something which is much more conservative than before, and which should be in line with the reality in the future. So under the present circumstances, we can consider that we are at the right level. Who knows exactly what will be the case if rates would further go down, but for the time being, it's not the case, and let's see the experience.
It's once more the difference between the possible and the probable. And the insurance business is to price on the probable, and the probable has deteriorated, not on the maximum possible. If you were to price P&C on the maximum possible, it would be unaffordable. Okay, Denis, on the other part of the question on offers for cash.
So on the second part of your question, I'd like to give a context for my answer. We have indicated that as part of Ambition AXA, we would devote more resources to the management of our in-force portfolios. And as part of this initiative, a team has been built in the US. That's the study that you're referring to. It's not a study, it's a full team that is dedicated to managing the in-force. And they are coming up with ideas and initiatives which make a lot of sense. The first one was the one which led to a positive change in reserves in the first half, which was to offer, to tell policyholders that they would not be able to make further contribution on past policies. The second initiative, which has been announced and will start, I believe, in October, it will be an offer to our GMDB policyholders, the people that have only GMDB, to buy back this feature against cash, so guaranteed minimum death benefit. And there will probably be other initiatives of the same nature, both in the US and in other territories, as part of this in-force management for value. But I don't have anything else to add to that question. This is ongoing. It's an offer that will start in October, but has already been announced in the US market. Your third question is on the dividend and the possible constraint on dividend. I think we are telling you now, as Henri has indicated at the presentation, that we are looking at our economic solvency, including equivalence, and this is the yardstick for the management of capital. That means that we are quite comfortable at the current level of 174%, and we see the minimum as being 100%. So we don't see any short-term constraints on the dividends.
May I just follow up? What proportion of your liability, your GMXB liability in the US, you can manage with these initiatives?
I cannot answer that question because, again, it's we need to look at various ideas, and that's something that will be an ongoing discussion, which will also depend on the evolution of the markets, of the evolution of our distribution, and so on and so forth. So I cannot give you a percentage.
Okay, thank you very much.
Thank you.
Next question.
The next question is from Mr. Blair Stewart from Bank of America Merrill Lynch. Sir, please go ahead.
Yeah, thanks very much. Blair Stewart here. I've got a couple of questions. The first one is just, I know you've not provided any explicit information on free cash flow, but perhaps could you give us an indication as to how you're progressing with regards to your free cash flow targets? Secondly, with regards to Ambition AXA, clearly capital markets are less favourable than you would or may have expected at the time the plan was put together. Is there more you can do, or would you consider doing more on the expenses side to compensate for those adverse capital market movements going forwards into the future? And thirdly and finally, I guess there's a question for you, Henri. As the CEO of the company, we've seen various issues coming up in the US. We had basis losses, we had volatility, we had a series of lapse adjustments as well, and we've now got partial withdrawals. What level of confidence do you have in that business now to expect some sort of break even or close to break even on the GMXB line going forwards? Thanks.
Okay, I'll start by the last part of your question. I think we have two elements in the US. We have the legacy book, and we have the efforts we are making to reorient the business and develop the new generations of products and the life part of the business. If I look at what is done by Mark and by his team, I'm comfortable. Of course, the legacy book has remained an issue, but if you look at the US activities as a whole, the US is profitable, certainly not at the levels where we were in the future, in the past. But the profitability is there. The development, the reorientation of the activities is progressing, and according to the plans we have. So the core of the question is, how does then the legacy book behave? And the feeling we have is that we are probably in the I would say at the end of or close to the end of the bad story, because who would have believed that interest rates would be that low in the US for that long? I think we have seen most of the changes. And once more, given the fact that the reorientation seems to be working, I think it's something we need to hold on, not being passive. I mean, there is a very significant degree of activity in the US to try to reduce the negative impact of the legacy book, to try to manage more actively the in-force to improve the situation. And you see in the numbers of the first half that the fact that we've stopped the drop-ins is an example and is bearing fruit. So we have more things like that to be done. So overall, I'm not going to tell you it's a pleasant situation. Of course not. We are paying the price for the mistakes made in the pricing of the first generation of policies, and the price has been heavy because of the evolution of interest rates. But in the long run, I think it would be a mistake not to be confident in the recovery of the US market. The other element I would add is that IFRS accounting is giving a pretty, I would say, accurate and non-complacent view on what the risks on these portfolios are. The US GAAP methodology is much more complacent, but I would say only for some time. And what is interesting for us is to start to see that some of the competitors are starting to adjust, reprice, and understand what the long-term economic issues are with the first generation of VAs. So we think there is going to be more discipline in the market going forward. We think that if the US economy recovers, and it could take longer than expected, but long-term rates will increase again. And this means that we have to, I would say, keep our exposure, but continue the very active efforts we are making. On the free cash flow indicators, on the expenses, Denis, do you want to say a word?
Yeah, free cash flow, I just would like to bring you back to slide 10. We have on slide 10 an indication that free cash flow for the first half were in line with Ambition AXA, and I don't think we need to tell you more because, as you know, we only publish the embedded value once a year. On the Ambition AXA plan and what the impact of the markets, you point to efficiency initiatives. I would say, as we showed, that we are well in line on our efficiency initiatives, and we have a plan over 5 years of 1.5 billion. We also have to invest as part of that plan, so we will not change our target there. The two areas where we are probably more focused at this stage are in the selectivity initiatives. On the P&C side, we will have to offset the fact that we will have eventually lower investment income going forward, and we will have to adjust our targets on the combined ratio side. And on the life and saving side, we need to accelerate our shift to protection and health, which is what we have done, because basically we've moved, as Henri showed, from 31% of new business to 41% of new business. We need to continue, I would say, and be more aggressive and imaginative on that front. Those are the two, I would say, key elements of our strategy to offset the impact of low interest rates.
Okay, very good. Thank you.
Thanks, Blair. Next question.
The next question is from Mr. Nick Holmes from Nomura. So please go ahead.
Oh, hi there. Thank you very much. Just a couple of questions. First is coming back yet again on economic solvency. You've already said that it's not comparable with other companies, what you're publishing. And really my question is, so why do you publish it? I mean, doesn't it just create more trouble than it's worth? And what sort of suggestion would you give to investors who are puzzled by all these different economic solvency ratios that are coming out from companies? I mean, not all of them, of course, are disclosing them. But what kind of guidance would you give? And then second question is coming back on the US. You said that it's becoming more rational, the competition, but I think there are still some companies that are still very aggressive out there. And are you really sure that rationality is returning to the market? Thank you very much.
Thanks, Nick, for these good questions. On the solvency ratios, there are differences. Some Europeans having activities in the US do not publish. That's true. Some Europeans are, as we've said before, not using real risk-free interest rates, but are, I would say, making some adjustments. What we want to do, I mean, first we publish, I could say, because you ask for it, point one. More seriously, because also we think that for the sake of transparency, we want to show where we are, and we want you to be convinced that we are fully prepared for Solvency II. What we do is because it's also the way we manage the business. I mean, our internal risk model is very much a Solvency II one. What we have done for this half year is to slightly change the way we present it, but we think it's fair because it's reflecting the evolution of the discussion with the regulators and the supervisors. Mr. Barnier has been crystal clear more than once, and both of these things are not always usual in I would say, the discussions with regulators. They are sometimes crystal clear, sometimes once, but being crystal clear more than once is something pretty unusual. On the fact that equivalence would be granted to the European players, because it's a core element of the level playing field global players need. As long as he had not been crystal clear, we didn't take into account the benefit of equivalence. We think now that we have good reasons to take it. We have not taken the benefit of the counter-cyclical premium and of the matching premium the industry is requiring to support a full move to Solvency II. And we would do it only if we were to reach an agreement on the finalization of Solvency II. But what we want you to know and to understand is that under the current stage of the negotiation, the ratio for us stands at 170 plus, which we see as being an extremely comfortable level. Doesn't mean that the discussion on Solvency II is over. There are still some very substantial points to be negotiated. The industry has been very clear on what is needed to adjust to the extravagance or inconsistencies of the model which is put today on the table by the Commission. We hope that we will progress. We will see. But at the I would say at the current stage of the negotiations, equivalence will exist. We think it's fair to take it in the number we publish, which is, on all the other elements, a pretty conservative number.
Thank you very much for that. Could I just ask a follow-up question, which is, what would the ratio, can you give us any sort of indication of what the ratio would be if the matching premium and the counter-cyclical premium were also agreed?
I'm not going to give you a figure. I would just say that you would probably be pleasantly surprised.
On the US.
On the
yes, on the US, I would agree with you that all the players are not yet totally
fully
rational, but I would say that the market is evolving in the right direction, and the fact that we have regained market share in the VA space in the first half is a reflection of that. It's the first time that we are regaining market share, not because we have been more aggressive at all, but just because the market has become somewhat more rational. There is still some room for progress there, but it's a very significant progress on the VA side.
Okay, thank you very much.
Thanks, Nick. Next question.
The next question is from Mr. Fabrizio Croce from Kepler. So please go ahead.
Good afternoon all together. I have three questions. The first one is about your reinvestment. The majority of your reinvestment is actually in fixed income. And if I look to your asset base, I have some 82% invested in fixed income. So then looking at your new investment, is the share bigger or lower? I mean, are you investing also in other asset classes, or are the 25 billion already 100% of your total investment? And that's the first one. The second one is in terms of direct business. The minus 1% are clearly driven by UK. Looking forward, what is a growth rate which we could expect for this business? Are we speaking double digit or still half?
Yes, to this part of the question.
Yes, so double digit.
Yes.
Okay. So, and then for economic solvency, the question is, even accepting the new equivalents, could you give a sensitivity for a double A ratio calibration?
Okay. Gérald, do you want to take it?
Yes. Concerning your question relative to the investment, we are not exclusively, of course, investing in bonds, but keep in mind that in a Solvency II world, Henri just said that we are already managing our business in a Solvency II world, and it's not new. We started a long time ago, and that explains why ALM is a key element of our strategy. So don't expect to move a lot from this 82% in fixed income. For sure, what we try to do is to diversify ourselves, as I explained, within this fixed income category. For example, investing more in loans, investing more in secured loans, and so on and so forth. On the other categories of assets, yes, we still have, for the time being, we have an investment in equity which is not so high. You have all the figures. That's due to the environment, but we are still investing in real estate, and we have some opportunities as well. We are still investing as well in private equity.
Sorry for following up on this one. To be more precise, the 25 billion is the reinvestment amount in fixed income. How much is the total sum which you are reinvesting?
That means that the total sum which is reinvested in the first half, roughly speaking, we invested mostly in fixed income. But we should have something like 2 billion more, 2 to 3 billion more in other categories of assets. But there we have been mostly in fixed income.
Okay, thank you.
Okay.
Next question.
No, sorry, the solvency.
Solvency AA.
We don't provide a AA solvency ratio.
And why is this?
Because that's not the way we manage the business. We don't provide. I mean, we use the economic solvency ratio as it currently stands. we do not intend to provide a double A economic solvency ratio.
Okay, thank you.
Next question.
The next question is from Anastasio Pantarotas from Cheuvreux. So please go ahead.
Yes, good morning to everybody. I have just one question left. I wonder if you can provide a sensitivity on your U.S. variable annuity business in the case the interest rates would fall further in the second half of the year. Since the end of H1, there was a decline of roughly 20 basis points, and I wonder if this could hit more your U.S. variable annuity in the second half of the year. If you can provide some sensitivity on this. Thank you.
Okay, Gerald?
As far as variable annuities are concerned, you keep in mind that, in fact, if you take all the adjustments and all the P&L from JMXB that we had over the last years, we have in fact two different categories of earnings contribution. The first one coming from basis risk and volatility. And if rates are going down in a quite benign volatility environment, then it's not a real problem. So that means that we would have some volatility losses, but nothing really different from what we posted in the first half. And the second one is the adjustment. So as I said, under our present current knowledge of the business, we consider that our reserves are at the right level. So nothing says that if rates would go 100 basis points down further, then maybe there could be adjustment. But for the time being, we don't have any indications that we should do it.
Okay, thank you.
Next question.
We have a question from Mr. Andrew Crean from Autonomous. Sir, please go ahead.
Good morning, all. Three questions, I suppose. Coming back to the US VA book, could you tell us what proportion of the US VA book are the policyholders in the money on the rolled-up guarantees? And also, say, in basis points, your hedge charges, how much is that? What's the average charge? And then secondly, on the VA book, could you talk a little bit about the proportion of the loss which is going to run through the P&L versus get put up on the balance sheet through sort of DAC reactivity? Because I think it's about 3/4 of the losses are currently going onto the balance sheet. And then finally, on the definition of economic capital required, in your embedded value calculation, it is the higher of regulatory capital and your economic, whereas I think when you calculate the economic capital coverage ratio, it is just purely your internal model. Could you therefore say what are the additional regulatory buffers to take it up to a sort of embedded value basis?
Gerald, do you want to take the question of VAs?
On the VAs, you asked for the hedge charges. Going back to the slide, which is on page 826. The VA base fee roughly is 150 basis points. So that means that if we have a slight drop between the VA base fee at the end of 11, for the first half of 11 and the first half of 2012 is due to the average amount of VAs. That's why we have a drop. So 150 basis poins.
But that's the basis point charge, isn't it? It's not the additional charge for hedging.
No, that's whole the hedges. So the part for hedging is much smaller than this. We'll liaise with you, okay. But the 150 is a whole. On the policyholder in the money, that means that, as you can imagine, with the present interest rate environment, we have a significant part which are in the money. But at the same time, it should be analyzed in the light of the unrealized gains that we have on our hedge on our hedge position, and today we should be the most hedged company as a whole.
What proportion is in the money?
I liaise with you on this point. On the DAC reactivity, 58%. That was the DAC reactivity on the first half of 2012. We told you 50% last time, so we are not very far from this level.
On the last part of your question, if I understood you correctly, Andrew, I believe that your question is appropriate at the local level. I don't believe it's appropriate at the group level, because at the end, the capital that will be required under Solvency II is going to be the economic capital. So there is no addition to be made at the consolidated level for additional local buffers. We have within our balance sheet to manage the fungibility issue, but I don't believe it would make sense to add on a consolidated basis some additional regulatory buffers that are local, because at the end, on a consolidated basis, we are regulated on this. We will be regulated on this economic basis.
We have a question on internet.
Yes, last question from Ralph again from KBW. When do you think will equivalence be formally granted? Are there still any risks that it will not be granted and you need to return to Solvency II in all territories? And please, can you confirm you manage your US business in accordance with RBC-based economic capital?
Yeah. On Solvency II, it's an ongoing process. We are at the stage of the negotiations where some progress has been made, equivalence, admission of the principle that a counter-cyclical premium and a matching premium are a necessity, but no agreement at all on the way it should work. So I think going forward, it's a pretty binary route. Either we can come to an agreement on the two last substantial points, and Solvency II will be enforced, even if it's later than expected, or we can't. And the probability is that there is not going to be, I would say, the necessary level of political support to implement it, and the European Commission will have to go back to the drawing board and come with another system. That's where we are. But we do not see a situation where something would come out without equivalent. What we see as an industry is we've been very clear in what we are requesting. All the cards are on the table. There is an ongoing negotiation process. There is a French word I don't know in English, cranté, locked. I think the important point is equivalence has been locked in the process, because Barnier has been very clear on that. So we do not see why they would step back and take a different stance. So it's a positive that this has been locked. We need to lock two additional things. One is a reasonable outcome on the counter-cyclical premium. The second one is a reasonable outcome on the matching premium. We hope we will have that. If not, going to be another question.
Your second question was related to the way the US business is managed. The US business is managed on two regulatory systems, because locally we obviously have to comply with the RBC regulations. And in some extreme circumstances, like at the end of 2008, we took some hedging positions just to protect our risk-based capital. So yes, we do have to take into account the US RBC in the way we manage the business, because on a regulatory level, at the local level, we have to comply with RBC rules. Having said that, in the way we price our products, in the way we manage our risk, we manage the business on an economic capital basis. This is the way the group looks at the risk, and we do it also for our US business.
Thank you very much. We are going to end the discussion here, which is not going to prevent us from answering your questions in separate meetings or offline. Thank you very much to all of you. We were probably wrong not to go to London because everybody tells us that London is empty and that traffic has never been that easy. But we thought it was a cautious decision to have this half-year presentation in Paris. We wish you well for your holidays. For those of you who are going to be courageous enough to take holidays in this interesting environment. Thank you very much.